Have you ever booked a holiday promising luxurious accommodation and top-notch amenities, only to find on arrival that it's lacking a star or two? If you're a football fan, you'll know the all too familiar tale of the pre-season hype followed by an underwhelming finish in the table. Taking a taxable lump sum from your pension can lead to similar feelings, as it has been far too common for the amount that you receive in your bank account to fall short of what you had anticipated. Since pension freedoms were introduced in 2015, due to the pay-as-you-earn system deducting excess income tax up front, over 470,000 claims have been made for refunds totaling 1.37 billion. The good news is that HMRC recently announced that from April 2025, they will begin automatically updating tax codes after the first taxable withdrawal from a pension, effectively removing the emergency tax code sooner. What difference will this change make? Before you make a withdrawal from your defined contribution pension, such as a personal pension or SIP, HMRC's pay-as-you-earn system is not aware that it exists. As you may know, we can normally withdraw 25% of our pension tax-free, but when receiving income from pensions, this is subject to income tax. When you take the first taxable withdrawal from your pension, your provider will put this through the pay-as-you-earn system with an emergency tax code. HMRC then typically issue an updated tax code within a few months, but from April 2025, this will happen automatically after the first taxable withdrawal, which will still be taxed on an emergency tax code. But will this change result in the correct amount of tax being deducted? In the tax year that income is received, it falls into income tax bands, which in the current tax year of 2024-25 are as follows. Now, if you're struggling to sleep, try reading the UK income tax code. It is notoriously lengthy and complex, with aspects like the high income child benefit charge and losing your personal allowance once you start earning over £100,000. But aiming to keep things simple here, let's say you have a salary of £30,000. You would expect to pay a basic rate tax of 20% on the next £20,270 of income. If you withdrew, say, £10,000 as income from your pension before tax, you would expect to have £2,000, 20% deducted, and receive £8,000 net. Unfortunately, if an emergency tax code such as 1257LM1 were used, you would only receive just over £7,000 after PAYE deductions, meaning you would have overpaid HMRC by just over £950. The reason is that the emergency tax basis only offers you 1/12 of each of the tax bands, with no acknowledgement of previous income or tax paid. With the standard 1257L tax code on this basis, it effectively results in the tax bands as follows. It is easy to see why taking larger withdrawals quickly results in having more tax deducted than you should be due to pay to HMRC. While this change from the new tax year is a step in the right direction, it does not eliminate the issue of overtaxation. The pay-as-you-earn system is cumulative, meaning it considers your total income for the year. If you make a large pension withdrawal early in the tax year, the system treats you as if you are going to receive that income monthly for the rest of the year, to evenly spread out those tax deductions. For instance, if you withdraw that same £10,000 from your pension on the 6th of April, the first day of the new tax year, even with the emergency element removed on a 1257L tax code, you would still have that same deduction, resulting in an overpayment. If you then take ad hoc payments later in the tax year, you should at least get closer to the correct tax deductions. And for those taking regular income, you should start to see tax refunded to you gradually through those payments throughout the tax year. The bottom line is that the pay-as-you-earn system doesn't deal particularly well with ad hoc income payments. There isn't a perfect system to deal with this. HMRC would still rather that you overpay and approach them for a refund than you underpay and force them into chasing you for the shortfall. This will mean that many people will still need to reclaim overpaid tax, particularly when taking larger lump sums in the earlier stages of the tax year. Given the complexities of the pay-as-you-earn system and the potential for overtaxation, Working with a financial planner can help you plan your withdrawals strategically to minimise the tax implications. Taking an initial smaller payment to trigger the removal of an emergency tax code before taking a larger ad hoc payment might be a strategy that is employed more regularly in future. As financial planners, we help our clients understand their tax codes, judge the right strategy on taxable withdrawals, and assist with any reclaims. A financial planner can help you set the right expectations for what you'll receive in your bank account, avoiding any nasty surprises. Ultimately, we can assist in making the experience of taking money from your pension a lot more straightforward.